This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour. Asian stocks are headed for early gains after a rally in big tech lifts Wall Street. Bond traders unite behind bets that the Fed will only cut rates by 25 basis points next week. Nvidia CEO Jensen Huang says they're facing tensions with customers over shortages as demand for their chips remains strong. And we'll be hearing from the founder and CIO of Oasis Management for their take on investing in Japan, plus talking business strategy with Apollo as the firm looks towards Asia.
Take a look at how we're setting up for the Asian session. We're seeing a little bit of upside when it comes to futures. We'll see if that's sustained, especially with Japanese stocks having lost ground for 7 consecutive sessions. Of course, a big function was the strength of the Japanese yen. We are talking about really leading towards that 140 level, but we've pared back from some of that strength against the U.S. dollar. We're at around that 142 level now. And a lot to do with what's happening in the U.S., right? I mean, we got those core CPI numbers. Take a look at how U.S. futures are setting up, because really we saw that Treasury market slumping, the 2-year yield rising about 10 basis points at one point. We have the dollar steadying on the back of that, but really to do with perhaps those bets of an outsized 50 basis point rate cut by the Federal Reserve going out the window. The core CPI number seeing its biggest increase in about 4 months, and shelter really leading to those gains. So we had in the New York session gains across the board, especially with a tech rally that set the Nasdaq 100 up more than 2%. We're seeing a little bit of downside pressure in the Asian session for futures, Heidi.
Well, of course, the Fed is on the cusp of its first rate cut since 2020. However, our Bloomberg opinion columnist John Authers thinks that the weight placed on consumers by costly credit will take a while to unwind. He joins us now to discuss this. And John, in your view, how big a risk is this to the outlook?
The weight of consumer credit is quite considerable because, as we know, monetary policy operates with a lag, and the lag seems to be much longer than usual. So there's plainly a risk. That's the big argument in favour of the Fed cutting aggressively at present. That they're not going to. That we haven't really even seen the effects of the great hiking campaign thus far, and we are going to start feeling that. So that would be the great reason why the market is betting as confidently as it is, that we have very significant rate cuts coming. We've got 10 rate cuts of 25 basis points at least over the next 2 years, if you believe Fed funds futures. Now that's the kind of cut that wouldn't normally be justified by the kind of inflation and unemployment numbers we have at present. It implies that people think things are going to get a lot worse, and certainly the health of the consumer, which has stayed us very surprisingly strong for a long time since the pandemic, would be a big part of that argument.
And John, you said it. I mean, there are so many bets right now of aggressive Fed easing. At the same time, when you have so many other uncertainties like the election, we have the Trump trade being unwound as well overnight. Yes. And let's not forget, we have an ECB rate decision also coming up. So what are we expecting in terms of market reaction to all of these factors?
Well, I mean, I think what you saw today was that the reaction more or less cancelled itself out. You saw the dollar weaken quite considerably during the debate itself. I think a Trump 2.0 is seen as plainly dollar positive. If he's really going to go through with tax cuts and hiking tariffs, that's going to mean a stronger dollar. Therefore, I don't really disagree with anyone. The great consensus of people who think that Kamala Harris had the better of that debate, that would be a reason for the dollar to go down. When it comes to the way the inflation numbers came through, it's quite startling how it almost perfectly cancelled out the fall in the dollar that had come with the debate. What's intriguing in the last few hours is the way the tech sector decided that it could happily ignore everything that was going on with monetary policy and politics, that people decided that there was a buying opportunity here in Nvidia and the other big tech names and acted accordingly. That's interesting that there is that degree of embedded optimism when there is so much embedded pessimism about the economy.
John, we were talking a little bit earlier about obviously the sort of gripping nature of the 90 plus minutes of this debate, and as sort of entertainment and fascinating as it was. Do you think it sort of moved the needle when it comes to policy risk or market risk meaningfully at all? And do you think market perceptions at this point are sort of right-sized on what we get in November?
I think it does move the needle, in the sense that the risks were asymmetric coming in. Anybody who hasn't worked out what their opinion of Donald Trump is by now, I would seriously worry for after 9 years in the public eye. But that's not true of Kamala Harris. And it was obvious entering the debate that those risks for her were weighted towards the downside. It would be very difficult for her to prove in one 90-minute session that she really was the next Roosevelt or Kennedy or whatever, but that it was quite easy to imagine her having a bad debate, losing their train of thought, making a few gaffes, and getting a lot of people to make up their mind against her. That didn't happen, plainly. That doesn't mean she's bound to win, but there was a big chance last night that that Trump would establish himself once more as the absolutely clear, overwhelming frontrunner, and that hasn't happened. So that does, in terms of how well we can gauge what will happen over the next 2 months, I do think that changes things. What surprises me is that if you talk to people about what they expect from either candidate, both of them think we're going to get irresponsible fiscal policy for different reasons. Too much spending from Harris, too many tax cuts and tariffs from Donald Trump. And all other things equal, that means that the Fed can't cut very much because it will be inflationary. And I know very few people who don't subscribe to their concerns about fiscal policy, and yet the weight of money in the bond market is what it is. That is a discrepancy I can't really explain, and it is concerning.
Bloomberg opinion columnist on Authors there. And let's get some more views now from Qiao, who's a financial advisor and managing director at UBS, and joins us now. Really great to have you with us. And I did want to pick up on that sort of discrepancy, or maybe the tension between these concerns over the fiscal spending potentially, or the tax cuts, depending on who wins the election come November, and what the implications are for the Fed. Do you think that markets at the moment are making space for that risk right now when it comes to Fed easing expectations?
I think the market is on the right track at this point. I mean, the general concern is still with the near-term election uncertainty, as well as some of the political and geopolitical risks. But I think the market is focused on the current AI trend, the current tech growth in the U.S. So as you can see today, I mean, there's just a huge bounce back and a correction from the recent lows in tech. And with all the noise around the elections, I think investors are still focused on the long-term growth in the technology sector in the U.S.
Yeah, that's interesting, right? Because there have been a lot of sort of existential questions being asked about, when we're going to see this return on an enormous amount of investment. Do you think even with the rebound, we should be bracing for more bouts of volatility and more of the sort of sell-off followed by a rebound, particularly when it comes to big tech?
Absolutely. I mean, I think in the longer term, tech is still going to take the lead in growth, but in the near term, with the election uncertainty, we are certainly a lot more cautious. And it's actually not. It is kind of a little predictable, especially with knowing that Fed is going to cut rates. One of our key concerns and what we're seeing in investors, it's really just trying to get the excess cash on the side. still from the build-up earlier this year to get that invested, because yields are coming down. So especially with the growth in technology and focusing less on the results of the elections or just the polling predictions, we're still seeing a lot of investments going into the market, especially taking advantage of recent volatility and possible continued volatility leading up to the elections.
But could that cut the other way as well? I mean, Qiao, you were listening to John Authers as well, and he was talking about whoever wins the November elections, there seems to be a perception excuse me, that there will be irresponsible spending and fiscal policies that could be inflationary. Is that a concern to you that the Fed may not be able to cut as much as they want?
Absolutely. I mean, we are expecting another 180 basis points of cuts in the next 5 meetings, all the way until mid of next year. But if it doesn't happen, the market could certainly pull back on that news because a lot of the cuts has been priced into the market. So it's definitely a concern. And what we're advising investors is just to stay invested, stay balanced, not to focus on any particular areas of the market, and also definitely invest excess cash, especially with investment grade bonds right now, to put some of that cash to work, locking in some of the yields, and just provide hedges against the portfolio, and that could be through buying more gold, more Swiss franc, so focus on currencies that are more stable. So and just protecting your portfolio and be invested for all scenarios. But we do feel the fundamentals of the U.S. economy is strong. Earnings are strong. And regardless of the results of the elections, this economy will probably continue to move forward, especially leading with the current tech and AI trend.
Interesting that when you talked about some of those safer hedges and you talked about currencies, you mentioned the Swiss franc, but not necessarily the Japanese yen. Are you considering the Japanese yen as one of those safe currencies, or is just the volatility that we're seeing in these days not something that you would want investors to touch at this point?
Yeah, that's a great point on the Japanese yen. I mean, we feel the Japanese yen, we do definitely expect lower U.S. dollar Japanese yen. So it's not a currency that we would say would be a good hedge at this point. We still like to focus more on the Swiss franc or on gold. And plus the Japanese economy, especially, they're probably going to keep rates as where it is right now. And probably delay cuts due to the current, the economy is still pretty fragile in Japan at this point. So we still, of all the currencies for hedging, we still like the Swiss franc a lot better.
I wanted to get your thoughts on our MLive blog question of the day, which is sort of, I guess, alluding to the point of how much of at least 25 basis points worth of cuts from the Fed is already priced in, right? How far will stocks rally on that 25 basis point cut? And, with that quarter point cut, are we potentially going to see almost a bit of disappointment given how far expectations have run?
Yeah, I mean, expectations is definitely the 25 basis point cut, or maybe even more, is already built into the market right now. But I think, especially with other kind of uncertainties that's in the market, I mean, anything could cause a pullback in the market. But still, what's in the driver's seat is going to be the economic indicators. And also is going to be, again, the Fed cuts. So we are just preparing for all scenarios. But still, we're focusing on the longer term, that the Fed rate cuts are going to happen, whether it's 25 bips or 50 bips or what's going to happen all the way until next year. The economy is in the right direction with, inflation's where it needs to be right now. Earnings are growing. So, regardless of what type of cut we're going to get, rates are going to come down. And it's overall a very strong point for the economy.
Qiao, good to have you with us, a financial advisor and managing director at UBS. And coming up on the Asia Trade, Oasis management joins us to discuss the growing intensity of activist campaigns in Japan. We'll hear from BlackRock Investment Institute as well on why they think the jobs data show market expectations for Fed rate cuts are overdone. Plus, we'll talk business strategy with Apollo as the firm sets its sights on Asia. But up next, Nvidia CEO Jensen Huang says the relations with customers are tense as the chipmaker struggles to meet demand. Details coming up. This is Bloomberg.
Delivery of our components and our technology and our infrastructure and software is really emotional for people because it directly affects their revenues, it directly affects their competitiveness. And so we probably have more emotional customers today, and deservedly so. And if we could fulfill everybody's need, then the emotion would go away. But it's very emotional, it's really tense. We've got a lot of responsibility on our shoulder, and we're trying to do the best we can.
Nvidia CEO Jensen Huang speaking at Goldman Sachs Technology Conference in San Francisco. Let's get more on those comments now and bring in our reporter Annabelle Jewelers in Hong Kong. Belle, who was talking about more emotional customers these days. What exactly is he talking about?
Well, emotional customers, of course, just refers to that intense amount of competition we've seen around AI and who can really claim victory in that space. Of course, if you really need those chips to satisfy that need or that quest, you are going to be a little bit emotional perhaps. But what was really important to investors going into this was to get more details around the chip well system and that rollout. And we actually did get that because one of the reasons we've seen such selling pressure on Nvidia, or one of the reasons, was that concern that perhaps there could be delays or snags in the production. But Huang said that the Blackwell is on its way. Demand from customers has been strong, and that TSMC, which of course is manufacturing these chips, is the best in its field. So they were just some of the key takeaways from what Huang said. In aggregate, that seems to have been enough to impress investors because last week, for instance, Bank of America was saying that details of the readiness of Blackwell shipments would be crucial to the recovery of Nvidia's stock. And again, if you take a look at how Nvidia performed intraday, it was the best session we've seen going back to early August, so about 6 weeks. And off the back of it, we as well saw other chip stocks like AMD, Broadcom rising in turn.
We've also done some exclusive reporting when it comes to fundraising at OpenAI.
That's right. Yeah. So OpenAI, of course, is the creator or the company behind ChatGPT. What we're hearing about here is possible fundraising. So sources are telling us that OpenAI is looking to raise about $6.5 billion from investors. What's really important here is the valuation it's seeking to do that at, because we're hearing it's $150 billion. Now, $150 billion, that does not include the money that's being raised, significantly higher than what we reported going back to February, because at that point we were talking about a tender offer being completed. The valuation was $86 billion. So $150 billion, again, really emphasizes or cements OpenAI is one of the most valuable startups in the world. At the same time, we're also hearing that the company is looking to raise a further $5 billion from banks. That would be in the form of a credit revolving facility. Or revolving credit facility, rather. But what's important there to note is that we have seen other tech companies doing that before, establishing those better banking relationships. Is this sort of the precursor to a possible IPO? Perhaps, perhaps not, but certainly something to think about.
Annabelle Jewelers there in Hong Kong. Time now for morning calls ahead of the Asia trading day, and Morgan Stanley's Mike Wilson says the stock market needs a new catalyst to resume its rally. Wilson says investors who bid up on equities on the AI potential in the short term were premature. He reiterated his preference for quality defensive stocks, recommending areas such as utilities, consumer staples and healthcare.
We just got overcooked on the whole AI theme. It doesn't mean it's over. We've written about this extensively. Like, we're not believers that this is going to change productivity materially in the short term. That's a long-term story.
Blackstone is cautiously optimistic about a soft landing in the U.S. CFO Michael Qiao says the alternative asset manager's own measure of inflation pegs it at 1.7%. Qiao adds that data suggests labor markets have been softening, and the firm expects wage growth to moderate in the coming year. Coming up, Germany joins Spain in calling for the EU to drop its plan for extra tariffs on Chinese electric vehicles. We'll have the latest on that story next. This is Bloomberg.
Germany is joining Spain in calling for the European Union to drop its plan to impose extra tariffs on Chinese-made EVs. Our China correspondent Min Min Lo is with us now. So what are we hearing in terms of this pushback?
Yeah, this is quite a surprising move. It came after the Spanish Prime Minister Sanchez visited China for 4 days, and at the end of the trip, he had called on the EU to reconsider these tariffs. And soon after that, you have a German government official, a spokesperson, welcoming the Spanish move. And it is surprising because Spain, we know, is one of those countries that had came out in favor of those tariffs, along with Italy and France. Not so surprising for Germany because we know that Germany has so far been quite opposed to those tariffs. They had abstained from that EU vote along with several other countries. But Spain is a country that rarely clashes with the EU. And in fact, before the Prime Minister's trip to China, he had said that while Spain wants to build that bridge with China to avoid a trade war, he says Spain will always be aligned with the broader EU position. So in this case, we know that after the tariffs, the provisional tariffs had been announced, China had retaliated by opening up probes into EU brandy, dairy products and pork products. And Spain just so happens to be the biggest pork product exporter from the EU. They sold $1.5 billion worth of pork to China last year and $50 million worth of dairy products to China last year. And also Spain is the second largest car producer in the EU, and they have been looking for investments from China to grow its own EV industry in Spain. That was part of the reason why Sanchez was visiting China. So all of these factors could have played into the consideration of whether or not to walk back those tariffs, and the prospect now is increasing for China to maybe convince more EU countries to support the rolling back of these tariffs on Chinese EVs.
And Min, given, though, the rising geopolitical tensions around China, we are seeing major car makers like Honda shifting their whole broad strategy in that market.
Yes, Honda is cutting jobs in China. It has offered compensation package for over 2,000 workers in its joint venture with a state-owned company, Dongfeng Motors. There you see the shares, stock prices going down on the news. And this comes as Honda's revenue in China, sales was down over 20% in the first half. It comes as this shift that we see in the entire car sector in China, as you know, the sales of the traditional internal combustion engine vehicles are down by about 15% in the first 8 months of this year. And on the other hand, you see the demand for EVs and hybrids going up. So the company said in a statement that this move is really to ensure sustainable operations and to help them speed up the transition towards electrification of vehicles. And at the same time, there is this intense competition in the Chinese market as well that's been hurting earnings of foreign competitors, the likes of those from America, Germany, and Japan as well.
Bloomberg's China correspondent Min Min Lo there with the latest on those geopolitical tensions around China and, of course, the EV market, which we'll continue to watch in the Asian trading session. But this is how we're looking in the currency space, because the Chinese yuan is holding steady at the moment at that 712 level. But it's the Japanese yen that has now resumed its losses against the U.S. dollar after incredible strength yesterday when we saw it head towards that 140 level. But of course, the U.S. CPI numbers seem to have changed the dynamic. This is Bloomberg.
Take a look at what we're seeing when it comes to the so-called Trump trade. And we are hearing sort of some analysts post the first presidential debate that we are seeing sort of that potential start of the unwind of the Trump trade, a combination of a weaker dollar, falling treasury yields, that drop in US equity futures that we saw yesterday going into the session, which ultimately, of course, saw that more of a tech-led rebound. We could see kind of that unwind according to the likes of Brown Brothers Harriman there. So a lot of questions still remain when it comes to what we got out of that debate. That sort of conversation really not seen to have delivered too much when it comes to moving the needle on policy risk and opportunities. Of course, lots of concerns from some parts of the market about potential fiscal spending and tax cuts from depending on which candidate you're talking about. But ultimately, potentially both of those outcomes could lead to more pressure on the Fed and more pressure on inflation, and therefore unwinding some of those expectations when it comes to jumbo emphasised Fed rate cuts. We also saw them push back when it comes to Bitcoin as well and broader crypto assets. Well, Donald Trump says he's not completely ruled out another debate with his Democratic rival, Kamala Harris. It's after saying that he wasn't so inclined to a repeat of Tuesday's forum.
I am not inclined to do it because I won the debate by a lot, but I think we let it settle in and let's see what happens.
Bloomberg opinion columnist Erika Smith says the vice president has knocked the former president off his game. She joins us now from Los Angeles. So give us your assessment of Kamala Harris's performance. And I guess the point is what was managed to be achieved by that, particularly in the minds of undecided or swing voters?
Yeah, so Kamala Harris, I mean, she really had two jobs going into the debate. The first one was to really kind of attack Donald Trump, which I think we've all seen that she did. And the second one really was to introduce herself to voters and, talk about her policies, talk about who she is, talk about who she's running for, why she's running for president. And I really do think she managed to do both. But I think that what's making the most headlines, of course, is the way that she was able to put Trump on the defensive in a way that, few people have been able to do in his political career. She needled him about his crowd sizes. She talked to him about, what foreign leaders say about him. I think she used the word disgrace several times, weak several times also. She was really able to get under his skin and rattle him. And so he really wasn't able to make a lot of the points that I think his advisors and he wanted to make going into that debate. So I think she came out victorious in that way.
Erika, and yet, despite the fact that we had that historic June debate between Trump and President Biden, most debates don't necessarily change the course of presidential elections in the United States. So what's next for Kamala Harris in order to be able to clinch the presidency?
Yeah, going into this debate, I mean, she really wanted to capitalize on the momentum that her campaign has already had. I mean, we've seen huge rallies here in the states. We've seen a huge number of people coming up to volunteer, even in states that are historically Republican. We've seen just a lot of excitement around the campaign. And so the goal going into this debate was to kind of maintain that momentum. And going forward from the debate, I think she wants to continue to do that. Her and her running mate, Minnesota Governor Tim Walz, are planning a bus tour that starts, I believe, this week. There are several other surrogates that are on the ground campaigning, governors from around the U.S. And so I think the whole idea is to continue to kind of beat that drum and continue this momentum over the next couple of months. I mean, and we have to remember, too, that, early ballots go out very soon. The election, while Election Day may be early November, people start voting in a matter of weeks. And so this is going to be happening in real time, and we're going to have an election before we know it. And I think Kamala Harris really wants to continue to kind of push this forward and to capitalize on the momentum she's seen so far.
And immediately after the debate, of course, we had the endorsement from, arguably the world's most famous childless cat lady. Do you think that makes a difference, particularly when it comes to turnout and mobilisation? Or do you think Kamala Harris, if she really wants to extend perhaps the lead that we're seeing, voters are going to want to see more from her in terms of policy specifics in her policy agenda?
Yeah, I think it both matters. I mean, I'm not going to be the one to underestimate Taylor Swift. I think that would be a bad move. But we've already seen, I think, reports today of a number of people that have, I think the number I saw was around 300,000 people have registered to vote based on the link that she gave on Instagram. So, that's no small number. I mean, we are very polarized as a nation in terms of, who we're going to vote for. But there's still those swing state voters out there and a number of undecided folks. And there's a lot of people who've never voted before or who don't vote regularly. And so if, Taylor Swift can endorse Kamala Harris and, 300,000 people decide to go vote, that's going to make a difference in this election. But I do also think that for the people that maybe have voted in the past who really do have more instincts or experience with politics, they want to hear the policies, right? And I think, Kamala Harris is coming at this with a very abbreviated campaign. She's just now rolling out a lot of her policy positions. And so I think people really also want to hear what she's going to do while in office. I think she made a stab at that during the debate, but I think that there's still much more to be said. And I hope that during the campaign she's out and about touring the country, that we'll hear more of that going forward.
Bloomberg opinion columnist Erika Smith there. And we do have breaking news at the moment on the Bloomberg. We're now hearing that former Peruvian President Alberto Fujimori has died from cancer. We had heard a few years ago that he was suffering from tumors on his lung and also on his tongue. He's a very controversial figure, of course, in Peruvian and world politics. He was convicted for his role in death squad killings before being pardoned last year. But this year he was making a comeback into Peruvian politics, saying that he would become member of the political party that's actually being led by his daughter, Keiko Fujimori, who has herself run unsuccessfully for the presidency 3 times. And these are some of the other stories that we're following at the moment. The U.S. and the UK are signaling they're open to Ukraine's request to use Western-provided weapons to strike deeper into Russia. Washington has so far opposed such moves, citing concerns it might deepen the conflict. President Biden is expected to discuss the matter with his British counterpart, Keir Starmer, where both men meet in Washington this week. Japanese Foreign Minister Yoko Kamikawa has declared her bid to become the country's first female prime minister. She's promising to strengthen price relief measures and boost real wages. Kamikawa is the 9th lawmaker and the 2nd female candidate to make a formal run for the ruling Liberal Democratic Party's September 27 leadership vote, with campaigning set to start today.
Take a look at watching when it comes to some of the downside that has really been dragging across the broader commodities complex, right? So much of this has been down to the downside sentiment in oil. We're seeing kind of a steadying picture there when it comes to crude markets at the moment. New York crude looking pretty flat. The biggest gain in more than 2 weeks was secured earlier. Hurricane Francine hitting key crude producing regions in the Gulf of Mexico. So at the moment, we're seeing kind of little change when it comes to New York traded crude at the moment after the hurricane made landfall in Louisiana on Wednesday night. Was potentially threatening a path that would hit 4 refineries, according to Bloomberg calculations. We're still sort of significantly lower in terms of crude pricing year to date. A lot of these concerns when it comes to top importer China at play here as well. And clearly those are the same concerns weighing on iron ore. Pretty flat picture there as we are looking ahead to the August activity data as well. That's not expected to come out of China with any great sense of robust recovery. And in fact, we're expected to see that recovery losing yet more speed there. Copper, though, seeing upside of about 0.7%. More ahead on the Asia trade. This is Bloomberg.
As AI technologies help propel automation growth, Bloomberg Intelligence sees Asia in the lead, with sales almost tripling to $217 billion by 2035. Senior industrials analyst Takeshi Kitaura joins us now for more on the market outlook. And Takeshi, I'm not surprised given the demographics, the aging population, shrinking populations. So I guess it's no surprise that Asia is leading in this market?
So one of the factors, I think, is also China as well as Japan. Also Europe will see population continue to decline, and this is working age population. So that generally translates to, if you want to continue to grow businesses, you need to automate processes. So Asia, we expect to see about 11% growth, and large part of that is coming from China, as well as other Asia, including India, which doesn't have a population issue, but has a lot of drive to grow.
So when we're talking about automation, are we talking about physical products? Are we talking about software?
So automation, and in this case, discrete automation, this basically means how do you automate the processes in the factories? And this is through capital investment. So robots is the easiest to imagine.
Yeah, robots, such a thing across Japan, right?
Yeah, so even us seeing some of this automation going into restaurants, for example, these are one of the areas newly as well.
Where do you see sort of the real shift when it comes to competitive landscape?
So I think AI in general, for example, will change the dynamics quite a bit. I think robotics, for example, has been primarily entered the automotive industry first. and other industries not so much. And part of that was the limitation of robots. You need to reprogram every time there is a different production sort of system. And now with AI, you can be more flexible in actually implementing these automation and with less sort of reworking of the programs as well.
Bloomberg Intelligence Senior Industrials Analyst Takeshi Kitara there. Let's get you some of the corporate headlines that we're tracking. Nippon Steel is mounting a last-ditch push to muster support for its $14 billion takeover of U.S. Steel. The Japanese steelmaker sent its senior executive, Takahiro Mori, to Washington for meetings this week as the deal risks being blocked by President Biden. While Biden, Vice President Kamala Harris and the former President Donald Trump have all spoken out opposing the deal, the view has been mixed among some lawmakers and steel union members. China has opened a criminal investigation into Haiwan Wealth Management for its alleged involvement in illegal fundraising. Shanghai police say they've taken what they call coercive measures against multiple suspects at the firm, but did not specify further. Talk on delayed payments on investment offerings distributed by Haiwan surfaced in December last year. More ahead on the Asia trade. This is Bloomberg.
I think it's more noise than news in the fact that the core number was slightly higher than expected.
I think at the end of the day, it was a disappointing reading. We were expecting slightly lower print last month. And, you know, we've had 0.2 cores now for several months, so jumping back up to 0.3 is certainly disappointing.
I think the inflation today at the margin is tilting investors towards 25 basis points in September.
The Fed should be moving people's expectations back from these large rate cut discussions into a much more gradual, steady approach at getting back to neutral and really begin the debate over what is neutral.
Overall, it looks very well controlled to me. It looks like we're not seeing deflation, we're just seeing a gradual disinflation. The inflation is gradually coming out of the system.
Bloomberg TV guests on the latest inflation numbers out of the U.S., which of course really reversed some of those gains that we saw in the Japanese yen. Yesterday, we were heading towards that 140 level, but actually after the core CPI numbers and perhaps the expectation that that outsized 50 basis point rate cut by the Fed was thrown out the window, we actually saw some of those gains reversing. We're seeing the Japanese yen at that 142 level. Nikkei futures pointing to the upside after 7 sessions of losses. Here in Japan, activist campaigns are increasing. Bloomberg Intelligence says there's been 77 activist proposals by the end of August, and that's compared to a total of 81 last year. And several of the proposals have been led by Oasis management. Joining us now in studio is founder and CIO Seth Fischer. Seth, great to have you.
Thanks for having me.
And thanks for coming in early, because I know you just landed from Hong Kong.
Yes.
No, I mean, you must be really busy. Are you taking any new stakes in companies, any new projects?
We're extraordinarily busy in our current engagement, and yes, in some new stakes, but primarily in working with companies and trying to improve their value.
Anything new that you'd like to disclose and take the opportunity to do so today?
You know, in every one of our approaches, we strive to work with management first, work with management privately, working with them to try to improve value for all stakeholders. If that works, great, and if not, then we'll bring it to other shareholders and yes, to everybody else. So no, nothing to discuss today.
I mean, we're seeing so much interest in Japanese companies. Is it the corporate governance? Is it the weak yen? I mean, Seven & I really is so much in focus right now. Are you interested?
Seven & I is extraordinarily interesting. I think that Couchard has put forward a very serious proposal to the company, and I'm a little bit disappointed with the company's reaction and response to Couchard. I think Couchard came back with a very strong response that they're willing to work with Seven & I, both in terms of national security concerns around keeping convenience stores open, and certainly about the important role that convenience stores play in Japan in all times. And I think that now the ball's back in Seven & I's court to respond and actually to open up a real discussion with Couchard in terms of how and if there's a transaction to go forward.
You said this deal is interesting enough for you to get involved is my question.
As I stated, in all cases, we strive to first discuss our positions and our investments with the companies and our thoughts on their governance and how they're approached privately with them. We have been a shareholder of 7 & I for a very long period of time.
So you do have a stake in 7 & I. Do you plan to sort of be able to use that in terms of how you view these negotiations and how this process could be moved forward?
We do have thoughts. I'd prefer to share them with 7 & I privately before we discuss it anywhere. I do think that this whole boom and this whole kind of continued amount of M&A is extraordinarily interesting. I think it's all a very strong result of the government continuing pushing open boards being open to consolidation across industries in general. I think there's a lot of pent-up demand in industries for consolidation. I think that'll unleash and improve margins dramatically and improve profitability for companies, which results in better results for all stakeholders. So yes, I think that there's a lot to be done. And a lot of that's due to both the fair M&A rules as well as the corporate takeover rules, as well as independent directors acting and fulfilling their duties.
The sort of tenor of the engagement so far suggests that this is about a shareholder value side of the concern, but of course there's also the argument that's been made that this is a business that should be designated, as having national priority as a matter of national security. Do you think that is the right narrative to apply? Do you think there is a broader kind of issue with a potential merger of these two companies?
I think national security is extraordinarily important, and as mentioned, I do think that convenience stores in Japan are important in national emergencies. The reality of life is, in terms of 7 & I's 20,000 convenience store network in Japan, the far majority of them are within 500 meters of other convenience stores. Qiao has said they're prepared to work with a divestiture of an appropriate number of 7 & I stores if the company would work with them so that it could protect national security. I agree that they form an extraordinarily important function in national crises, and that function should remain. Maybe that means that some of those stores should be sold to a domestic owner in a result of a merger or a purchase. And I think there's plenty of buyers for those stores, but that's a minority of the 7 & I stores across Japan.
So, Seth, you continue to emphasize that you need to have those conversations with the companies privately first, right? What can you disclose on the conversations about, say, DIC, because you're the second major stakeholder there, right? I mean, they want to sell that Kawamura art museum.
Have you been?
No, I want to, but they're going to close it very soon, so I better hurry up. What do you make of that?
We continue to be engaging with DIC and about them continue improving their business, continue to improve their governance, continue to make sure that the assets work for the company and for all stakeholders in the company. And so, yes, there's a lot more to be done there.
When it comes to selling all of that art, there's been a lot of criticism around that. How do you respond to that?
The special committees looked at this very carefully. I think that there's continued to be, there is, at this stage, this is like an example of a lot of other companies within Japan where the result is that there's an enormous amount of assets that are not working appropriately for all stakeholders. By the fact that you haven't been in the museum is a sign in and of itself.
I just arrived, to be fair. I've been here 2 months.
It's a sign in and of itself. Unfortunately, it's far away and it's not well trafficked, and people don't go there. So it's actually, unfortunately, there's more security guards most days than people looking at the art.
Seth, you've put the pressure on Shery. That's her weekend plans now. But, I do wonder, in terms of a broader framing of what we're seeing in Japan, what role do you see being played by activist investors like yourself in terms of driving the momentum of M&A action, right? Do you expect to see more of these deals and proposals to happen as a result of activism?
I think we're just one piece of the entire, of all stakeholders to go ahead and, yes, improve corporate margins and go ahead and, yes, and have consolidation. Some of the activists end up being vocal pieces of that, but I think that the conversations we're having with senior management, and they're even much more active, much more aggressive, and much more dynamic in trying to have that consolidation. They see the margin improvements potential. They see the need of it, quite frankly, within both the demographics of Japan, as well as just like the fact that we haven't had a lot of this M&A for 30 and 40 years, and the pent-up demand to have that M&A that would just unleash a lot of value. So I think we're just one piece of a lot of other participants there.
A lot of other participants, including private equity firms, right? I mean, KKR, Bain. What do you make of that offer for Fujisoft?
Look, I actually think that competition is fantastic. And I think competition for these companies is fantastic. I think what we've seen is a much higher premiums in every one of these transactions that are truly third-party market bids and actually in competition. So I encourage there being more competition for this, for all assets. So yes, Fujisoft I think is a very good result, and I implore corporate directors in general when they're looking at when they're looking at M&A to think about time value money, which sometimes they're not. Think about the surety of actually transaction. Right? Think about adhering themselves to the fair M&A rules, right? Majority of minority, and engaging with stakeholders about those transactions. But yes, they need to be open, and in many of these cases, open themselves to NDAs and open themselves to due diligence so that there can be more competition for those assets.
Seth Fischer, good to have you with us in studio. Please be back. Very interesting conversations with the founder and CIO at Oasis Management. And we do have breaking news here in Japan as well. We're following producer price numbers. The PPI index year-on-year growth of 2.5%, which is missing to the downside on expectations of 2.8% for the month of August. It's also slowing down from 3%. But of course, we continue to follow the producer price index because, of course, this has to do with where the Bank of Japan goes from here and how it translates to that inflation pressure in Japan. And month on month, it's a contraction of 0.2% for the month of August. We do have the BOJ policy decision next week. The expectation is for no rate hike, especially given that BOJ members continue to talk about having to watch financial volatility in the markets. Sydney, Seoul, and Tokyo opens next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens, and really the reaction, Heidi, when it comes to that faster than expected acceleration of core CPI numbers in the U.S. and how that impacts Asian assets today.
Yeah, really that half-point expectation from the Fed is sort of thrown out the window if you take a look at bond market expectations, right? There's also the political overlay because post that presidential debate, still a lot of questions as to, what each candidate's policies fiscally could mean for the fight against inflation and for the path of easing for the Fed.
Yeah, so we'll be watching specific sectors like crypto-related assets, not to mention energy-related assets, of course. But it was really the U.S. CPI numbers overnight with the Treasury market slumping as well that had an impact on the Japanese yen as well. Because before those numbers, we had seen really those gains against the U.S. dollar of about, we went towards 140 at one point, but that reversed after the U.S. CPI numbers. And right now we're seeing really those losses accelerating for the Japanese yen against the U.S. dollar. We're seeing it above that 142 level, and especially given that when it came to producer price inflation here in Japan just minutes ago, we saw it surprise to the downside, and really on a month-on-month basis a contraction as well for the month of August. So how that sets up the Bank of Japan next week, of course, is a key question. We had been hearing that they didn't really want to move if we continue to see volatility in the financial markets. The Nikkei finally seeing some rebound of more than 1.5% right now. Japanese stocks have been losing ground for 7 consecutive sessions. But take a look at how South Korea is also coming online, because we have seen the Kospi at levels that we haven't seen since the August 5th meltdown. We're seeing a little bit more positivity, up 1.3%. And the Korean won holding at that 1340 level, of course, especially Haidi after that rally that we saw in U.S. stocks overnight.
Yeah, and we are just sort of waiting to see whether that sort of passes through to some of these other markets, Shery, across the region, including the start of staggered trade here in Australia. We're seeing the ASX 200 pretty flat in those first few minutes of this gradual session coming online there. The Aussie dollar, though, pretty resilient, 6.75, despite, of course, the weakness that we've had through some of those commodities-linked assets and some of the weakness that we continue to expect from China ahead of domestic activity data to be released from China as well. Watching bonds, we've seen that sort of carry through when it comes to Australian bonds, opening the session lower, following treasuries, of course, which saw that fall after the CPI data you mentioned, all but really snuffed out the chance of that 50 basis point Fed rate cut next week. We've seen that 3-year yield here in Australia climbing about 5 basis points, about the same amount when it comes to the rise in 10-year notes as well. The Aussie dollar just extending the gain of about 0.3% that we saw in the middle of the week there. And also watching some of the energy markets. Of course, oil is pretty steady at the moment. Some of those concerns perhaps put aside from Hurricane Francine and the risk to some of those Gulf of Mexico refineries.
Our next guest is cautious with anything more than a 25 basis point cut from the Fed. Ben Powell, Chief Middle East and APAC Investment Strategist at BlackRock Investment Institute, joins us now. And Ben, great to have you with us. I mean, have market expectations gone too far? I mean, that 50 basis points expectation seems to be out the window, but at the same time, what's the risk of more volatility, given that we are expecting the Fed and also the BOJ to come out next week?
Yeah, it's an interesting time in financial markets, that's for sure. And yes, we at the BlackRock Investment Institute, we do think market pricing for the Fed easing cycle has gone too far. So the market is implying something like 250 basis points of cuts between now and the end of next year. We think that's too much. And the reason for that is, sadly, we think the inflation fight is not over. That's been our view for a long time, and we got a bit of a reminder of that yesterday with the CPI data coming in a little bit hotter. So we absolutely think they will cut next week. 25 basis points will begin. Of course, that's interesting and important. But perhaps the bigger question is how much they can do over the cycle. And yes, we think the market is overpriced. A little bit more than 250 is where the market is. We think that's too much, given inflation, sadly, is still a problem.
And yet, with yields rising, with this whole reaction that we saw in the broader markets, tech managed to rally. A lot of people thinking, okay, this perhaps is a good time to buy. Is this still a sector that can lure investors?
Absolutely. So our second half outlook, our main theme, or our first theme, I guess, is called Getting Real. This is the idea that we should be spending relatively less time thinking about central bankers and monetary policy. Of course, they're still super important, but the era of kind of super low interest rates and central bankers being able to kind of ride in like superheroes and save the day, for us is less obvious now, given inflation continues to be a problem. Central bankers are, in our assessment, still a little bit constrained. So that means we need to focus on the real aspects of the economy, those sectors and companies which can continue to generate sustainable free cash flow and all of that. So tech at the moment continues to be front and center in that. The AI megaforce continues. We're fully on board with that. I would say a little bit of nuance is probably useful. We are getting more excited, I guess, about the broader AI ecosystem. So the energy requirements, so utilities, materials, that broad ecosystem, because the silicon brain, just like us as a carbon brain, needs that energy architecture to kind of feed itself. So AI enthusiasm, absolutely, we're on board. A bit of nuance, but the broader point is we as investors need to be focusing more on getting real, focusing on those company sectors and so forth that can actually make money, even in what we think is going to be a higher rate environment for years to come.
The rate environment, though, and I suppose the nuance of whether it's going to be a quarter point or a half point, or maybe there's another jumbo size cut to come. This is sort of the question of the day from our AIM Live blog, which is how much, I guess, further gas is in the tank when it comes to the potential for this broader rally on just 25 basis points. Do you think that's pretty fully priced in now?
Yeah, I think so. So as you've observed earlier, the expectations for 50 bips have been reined in. We always thought that was unlikely. So we at the BlackRock Investment Institute think they'll do just a couple, meaning 2 cuts this year, because in our assessment, again, the inflation battle is not over. I think over the last few weeks, The market's been a little bit complacent and totally focused on the jobs growth side. Of course, that's important, but it's called a dual mandate for a reason, and inflation is not at target. Wage inflation continues to be rather high and perhaps not consistent with getting back to 2%. So we think they will begin the cutting cycle next week. Obviously, that's super important. But they are not going to be able to do as much, in our judgment, as the market is implying. And what's more important when we think about the equity view is the relative performance of different sectors, companies, business models. So old-fashioned investment, rather than so much focus on central bankers. Still very important, but marginally more attention we think should be being paid to the actual companies themselves rather than the macro interest rate environment from here.
Is there much that's compelling to you in terms of opportunities in Asia? I see you're constructive on Japan equities, underweight on Japanese bonds, and pretty much neutral on everything else.
Yeah, we're really quite constructive on Japan equities. By the way, at the margin, I guess the Fed going a bit slower is useful. So we've got this kind of very careful interest rate normalization from the Japan side. So what you should see over time is interest rates differentiation narrow a little bit between the US and Japan, so the yen, one might think, should appreciate. That's fine, but we don't want too much too quickly, right? We don't want too volatile a move in the FX, which can kind of confuse and muddy the waters as to what the BOJ is going to do and what we as investors should be thinking. So actually, a Fed moving a bit slower is somewhat useful for the Japan call. Now, having said that, again, my whole sort of frame is we should be focusing on getting real and focusing on what's going on at kind of the corporate level. And I think that's the real story in Japan. This nominal GDP boom is a strong word, but relative to 20 years of flat nominal GDP in yen terms, up and to the right is different and quite positive, we would suggest. So that's still kind of very significant and obviously a much better environment for companies to be operating in. More recently, you've seen real wages, so this is wages adjusted for inflation, turn positive for the first time in a couple of years. So I think what you're going to see over the next few months is a little bit of a feel-good factor flow into the Japanese consumers. Some signs of that in some of the surveys, still very early days, but I think that's going to continue. So overweight Japan, a kind of benevolent macro backdrop. The BOJ, even though normalizing, of course, still very expansionary policy. Right. But the real story is Japan itself, where we're seeing this GDP reflation story really catch hold, we think.
And we're seeing a little bit of bargain hunting in today's session as well, because we're seeing the Nikkei now gain more than 3%, but really not enough to retrace some of those losses that we saw in the Japanese market over the past 7 sessions of declines. But I have to wonder, though, I mean, we were speaking to an earlier guest about these hurdles against some of those M&As, for example, 7&I, and potentially the company seeking government protections. And of course, we just have more technological protectionism, not only in Japan, but in other countries. Will this sort of dampen the mood or make it more cautious for investors when they're looking at all of this positivity over corporate governance and shareholder value here in Japan?
As a brief aside, we would be long Japanese equities unhedged, just by the way. We think this is a Japan, meaning Japan story, so we would be long the equity space on an unhedged basis, so you're actually benefiting from that stronger yen tailwinds. To your actual question, the corporate governance reform, I think, is still a very exciting story. You know, over the last 18 months, we've seen really historically amazing changes from the Tokyo Stock Exchange, strongly encouraging really strongly encouraging Japanese companies to treat shareholders better and more fairly. I think that's real, it's ongoing, but it's not perfect. So there's still a lot more to go. It won't be a story without some steps backward as well as steps forward. But don't miss the point, at least for us from the BlackRock Investment Institute, nominal GDP reflation story multiplied by a corporate governance story, which we think is real and ongoing, for us equals overweight Japanese equities on an unhedged basis to benefit from both the Japan story plus potentially a yen strengthening over the next period of time.
Ben, always great to have you with us. Ben Powell, Chief Middle East and APAC Investment Strategist at BlackRock Investment Institute. Take a look at some of the movers that we're watching. Asian shipbunkers are certainly among some of the biggest movers to the upside there. The likes of SK Hynix up by over 6% after the jump that we saw in Nvidia. Really, that rally in the US session was really boosted by the moves in big tech. Nvidia soaring more than 8%. That's another $216 billion added in market cap. We heard from the CEO, Jensen Huang, highlighting the limited supply situation, strong demand for its latest generation of chips, really talking about that customer relations are tense and perhaps emotional due to some of the stock shortages that are going on at the moment. So we're seeing that reaction. We also had some news when it comes to OpenAI as well. The funding set to potentially propel the value of the startup to $150 billion, with that discussion being reported by Bloomberg of that $6.5 billion in equity financing. More ahead on the Asia trade. This is Bloomberg.
Delivery of our components and our technology and our infrastructure and software is really emotional for people because it directly affects their revenues, it directly affects their competitiveness. And so we probably have more emotional customers today, and deservedly so. And if we could fulfill everybody's need, then the emotion would go away. But it's very emotional, it's really tense. We've got a lot of responsibility on our shoulder, and we're trying to do the best we can.
Nvidia CEO Jensen Huang there speaking at Goldman Sachs' technology conference in San Francisco. Let's get more on how those comments really managed to move markets as well, particularly as we see that rise really being reflected in Asian chip stocks at the moment as well. Our tech reporter Annabelle Jewellers joins us in Hong Kong. So it's an interesting characterization of the emotionalness of his customers.
Yeah, well, it just certainly speaks to the level of urgency around that AI race that we have right now in the market. But as you said, yes, we are getting that sort of market reaction. I mean, taking a look at some of those chip names here in Asia, Samsung, SK Hynix, Tokyo Electronics, these are all moving higher off the back. It does seem that Jensen Huang, the comments that he made at that conference in San Francisco have been enough to reinvigorate the investor appetite, not only around its own stock, but around that health of the AI rally in particular, because you are seeing again those big gains that we had intraday or overnight for the likes of AMD, Broadcom, so peers to Nvidia in the space. But just getting back to what Jensen Huang said in particular, because of course it was all of that question around the Blackwell chip rollout. Would that be proceeding? He said demand has been strong. TSMC, of course, is the manufacturer of these chips. It's also the best in the market, so a big tick of approval there for it, and that really, it seems enough to impress investors at this stage. Again, going back to what they have been looking for, Bank of America, for instance, had a report out saying that the readiness of Blackwell shipments would be key to the recovery in the stock. And again, it seems like it's been enough to assuage those investor fears at this stage.
And Bell, of course, at the center of this exuberance over artificial intelligence, OpenAI, and they could soon be raising billions of dollars?
That's right, yeah. So this is a Bloomberg scoop that we have, but just talking about the amount that it's looking to raise here. So $6.5 billion is what we're hearing in terms of equity financing for investors. What's really interesting is the valuation, because going back to that point around the exuberance and the AI hype, at the beginning of the year, we were looking at a valuation of around $86 billion, and that was around a tender offer for the company. This is now looking at $150 billion. So it's a huge jump just in the space of a couple of months here. What else we're hearing is that OpenAI is talking to banks, and they're looking at getting a $5 billion revolving credit facility. That's not unusual in the tech space. We've seen it from other tech giants in the past, but it can be a precursor to a possible listing, because startups can look to get better banking relationships ahead of that. Of course, big question marks over that, but just saying it's something we've seen in the past, so perhaps a little bit of precedent there. But OpenAI, yes, looking to fundraise and looking to also increase its valuation quite substantially.
Annabelle Jewellers there joining us from Hong Kong, and staying with tech. Huawei unveiling the world's first triple-screen smartphone just hours after Apple's iPhone 16 launch in an attempt to steal the U.S. firm's thunder. But Bloomberg opinion columnist Catherine Thorbecke says that consumers are losing from the showdown between Apple and Huawei. She joins us now in the Tokyo studio. And Catherine, let's start with how the iPhone 16 has been received in China, because that has been a historically difficult market.
Right. So the big sell of this new iPhone 16 is really the AI features. And these AI, the so-called Apple Intelligence features, actually don't launch in the Chinese language until next year. And then they're actually subject to regulatory approval before they launch in China. So I think there's been a lot of sort of disappointment on Chinese social media. They're saying, what is the point of this, new phone being so expensive if we don't even get these AI features? And in terms of hardware upgrades, those were pretty minimal and not super impressive. So it hasn't really landed in China.
What about when it comes to Huawei's and its trifold phone?
Right. So this was like sort of a really impressive, hardware feat. But at the same time, it comes with a $2,800 price tag, which is, quite jaw-dropping at a time when Chinese consumers more broadly are sort of pulling back on spending. So in that sense, it's almost kind of a slap in the face, even for the most sort of patriotic Chinese consumers that are really cheering for Huawei's success.
Who do you think will end up winning that premium market in China as we get into the upcoming holiday season?
Right. So, we'll have this looming showdown for the premium market coming into the holiday season. And I think Huawei is still probably going to release a new set of their flagship Mate 70 phones. And that could have a lot of influence on the showdown. But right now, this is just my opinion, but I think we'll see more Chinese consumers actually choosing to hold on to their current smartphones a little bit longer.
Bloomberg opinion columnist Catherine Thorbecke there in Tokyo. Well, Germany is joining Spain in calling for the European Union to drop its plan to impose extra tariffs on Chinese-made EVs. Our China correspondent, Min Lo, is with us out of Hong Kong. So, Min, was this a bit of a surprise in terms of this pushback that we're seeing within Europe?
Yeah, it is quite surprising given that Spain has come out in favor of these tariffs previously, along with Italy and France. But now Spain seems to have changed their minds after the Prime Minister visited China over 4 days. And at the end of his trip, he had called on the EU to rethink this tariff. And soon after that, you have a German government spokesperson welcoming that move. And so this raises the prospect of China maybe being able to convince enough of their European partners to walk back or at least lessen those tariffs before the decision is made by end October. Now, why is Spain changing its mind, you might ask? It could be because China has so far retaliated by opening up probes into pork products and dairy products from EU, and Spain is the largest pork exporter to China. They sold $1.5 billion worth of pork to China last year, $50 million worth of dairy products to China last year. And also, Spain is the second largest car maker in the EU. They need a market to sell their cars overseas, and at the same time, Spain is looking to attract Chinese investments to build up its domestic EV industry in Spain. That was part of why Sanchez was visiting Beijing as well. So all of these factors could have played into the consideration as to whether to continue supporting these tariffs.
Well, we might get more tariffs coming from India on Chinese steel, according to reports. What's this about?
Yeah, so India is looking to impose tariffs of between 12% and 30% on some steel products from China and Vietnam. And this is coming as Chinese steel makers have warned of a prolonged winter ahead amid this domestic demand slump in China. And so steel makers in China have been looking to export more overseas to get their surplus abroad because of better margins overseas as well. And that is crimping on margins of overseas steel producers. Tata Steel, for instance, saw their revenue come down by, I believe, about 7% in the second quarter. So as you see on the screen there, volumes of Chinese steel exports has surged over the past couple of years, but prices have slumped. And so India is now joining a list of other countries to impose tariffs on Chinese steel. Other countries include US, Canada, Mexico, Chile, Brazil, and there are other countries in Asia as well considering similar moves to increase tariffs on Chinese steel, including maybe Indonesia and South Korea as well.
Bloomberg's China correspondent Min Lo there. And of course, we're looking at futures trading in Europe as we head towards the ECB rate decision. The expectation right now is for a rate cut. And this, of course, after their first rate cut after the pandemic came in June. Right now, we're seeing the Stocks 50 futures gaining 1% at the moment. Of course, we had a broad rally going on right now because of Wall Street rally overnight after the US CPI numbers came out. Here across Asia, also were broadly in the positive. We're more ahead on the Asia trade. This is Bloomberg.
This is the Asia Trade. The top stories that we're following this hour. The US and the UK are signalling they're open to Ukraine's request to use Western-provided weapons to strike deeper into Russia. Washington has so far opposed such a move, citing concerns it might deepen the conflict. President Biden is expected to discuss the matter with his British counterpart, Keir Starmer, when both men meet in Washington this week. Japanese Foreign Minister Yoko Kamikawa has declared her bid to become the country's first female prime minister. She is promising to strengthen price relief measures and boost real wages. Kamikawa is the 9th lawmaker and the second female candidate to make a formal run for the ruling Liberal Democratic Party's September 27th leadership vote. Campaigning is set to begin today. Former President Donald Trump says he's not inclined to have another debate with Vice President Kamala Harris, but left the door open to a potential second contest if it would be hosted by NBC or Fox News. Analysts and a CNN Snap survey suggested Harris won the debate on ABC Tuesday. Peru's former leader, Alberto Fujimori, has died at the age of 86. His family says he had been battling cancer. Fujimori is known for overseeing the defeat of Maoist terrorists and taming hyperinflation. He continued to loom large over national politics, despite being imprisoned for his role in killings by death squads. Let's take a look at how commodities are trading after what has really been a difficult few days. We are seeing some signs of stabilisation, particularly when it comes to the crude front, those sort of risks being posed by the path of Hurricane Francine and the potential impact of what it could do to at least 4 refineries in the Gulf of Mexico, really starting to sort of boost prices a little bit. That's why we're seeing the steadying after the biggest gain in more than 2 weeks in oil prices. The impact potentially on key crude producing regions of the Gulf of Mexico still in questions, but traders are also hedging a bit going into expectations of more market insights from the International Energy Agency as well. The shut-in of about 670,000 barrels a day of production, that's about 39% of the total being attributed to the impact of Hurricane Francine. Still, though, on a year-to-date basis, we're seeing that drag when it comes to lower Chinese demand, and that is clearly the picture when it comes to iron ore as well, looking pretty flat trading in Singapore. We are seeing a bit more market upside when it comes to copper prices at the moment. Those gains after the CPI data could cut expectations.
I think it's more noise than news in the fact that the core number was slightly higher than expected.
I think at the end of the day, it was a disappointing reading. We were expecting slightly lower print last month. And, you know, we've had 0.2 cores now for several months, so jumping back up to 0.3 is certainly disappointing.
I think the inflation today at the margin is tilting investors towards 25 basis points in September.
The Fed should be moving people's expectations back from these large rate cut discussions into a much more gradual, steady approach at getting back to neutral and really begin the debate over what is neutral.
Overall, it looks very well controlled to me. It looks like we're not seeing deflation, we're just seeing a gradual disinflation. The inflation is gradually coming out of the system.
Bloomberg TV guests there on the latest inflation numbers out of the US and how that's really sort of reset some of these expectations of that jumbo-sized move from the Fed. 25 basis points is now kind of front and centre now for these markets. If you take a look at bond market trading, take a look at how the equity session is progressing. We are seeing that sort of tech-driven surge driving a lot of the gains in Asia today, particularly when it comes to the sort of clawing back of the losses that we saw from Asian chip makers. We're now sort of back to levels that we had on about Monday with the likes of SK Hynix driving markets in East Asia a little bit higher. The Nikkei 225 seeing that real pop of 3.3% at this point. Looking to that Fed rate cut, the cost be up by 1.3% there as well. And we are really seeing the topics in Japan up the most in almost a month as well. We're also seeing the play of the yen reversal as well from that strongest levels since the dollar, against the dollar, I should say, since December. And we're seeing US futures ticking a little bit higher there after we saw the S&P 500 closing over 1% higher. Of course, almost double the gains for the Nasdaq, Shery.
And Haidi, let's talk about one firm who's investing heavily here in Asia. Apollo seeing the revamp of its Asia business paying off as the alternative asset manager continues its expansion in the region. The company is looking to lure capital from insurers and institutions that handle money for retirees in the region, including, of course, Japan and Australia. Joining us now is Matt Michelini, head of Asia Pacific at Apollo. Matt, great to have you with us finally.
Thanks for having me. It's a great studio.
Yeah, great. Thank you very much. It's a whole new studio. It's been in place for 2 months or so. But tell us a little bit about your drive here in Asia, because I think in April you guys said that you raised about $35 billion. Do you have an updated figure, or how much of that comes from Japan maybe?
Yeah, so I don't have an updated figure for you. However, the capital raising part of our business is going very well in Asia. The global wealth business, which is basically distributing our product to average savers, is going really, really well in Hong Kong, Singapore, now Australia, Korea, Japan. So that continues to go quite well. The insurance business is better than ever. The demand for guaranteed income by everybody, insurance companies, pension plans, sovereign wealth funds, individuals, is really going through the roof. And so that business has been going quite nicely. And it's really driven by the demand for a replacement for public fixed income and a replacement for public equity. You know, both of those asset classes have played an important role in traditional portfolios. That role has changed. We all know that that role has changed. We all know that those markets have become beta markets. And so as investors' demands and needs are changing, especially as they start to retire, they need an alternative to those markets, and that's when they come to us.
Is there a shift in perception when it comes to private markets? Because we have seen incredible volatility when it comes to even the yen carry trades being unwound, and just take a look at the Japanese markets right now, up and down, up and down.
Yeah, you raise a great point. I mean, stepping back to alternatives. Alternatives used to be defined as risky stuff. Private equity, venture capital, hedge funds, and then you had some macro bets like real estate and infrastructure. But as you've had capital provided, not by the banks anymore, but by the private markets in the U.S., and you're also going to now see that in a major way, I think, come to Europe, you now all of a sudden have we've challenged the notion of alternatives being, privates being risky and publics being safe. You now have safe privates, risky privates, safe publics, risky publics. And so, yes, what investors want is they want what the banks have had access to for 20 years. They want the nice, safe, consistent yield with very low loss ratios, underwritten on a fundamental basis, not mark to market, not subject to the gyrations of the market, where the yen carry trade or an unwind of leverage can cause extreme volatility in portfolios. That's absolutely what investors are looking for.
And when I was speaking to Mark Rowan just a few years ago, he was so optimistic about the Japanese market, but that was even before inflation had properly set in. Has the appetite sort of changed, especially now when people are thinking you actually need to guarantee some income into retirement?
Yes. Well, Mark's crystal ball is uniquely very good. So maybe he knew.
Okay,
maybe he knew. But absolutely. Look, I think that the increase in inflation, increase in rates has been a major boom for our business in Japan. On the investing side, you think about it, money's been free for essentially 30 years. And so, you know, if the ice cream shop is giving away free money, you'll accept vanilla. But as money starts to cost something, and as the Tokyo Stock Exchange has required companies to really look at their balance sheet and ask themselves, are you being efficient with shareholder money? You know, they first turned to the traditional tools, dividends, buybacks, sell a company. Sell a company plays right into our private equity strategy, and we've been quite successful here, having just recently bought a division from Panasonic. But then you start getting companies asking the question today is, well, if I'm going to pay for my money and I can't just easily roll it over with bank funding, should I pay a little more for duration? Should I pay a little more for flexibility? Should I pay a little more for something that is better rated on my balance sheet? And these questions are starting to get asked by Japanese corporates. And so I think that the tools that exist all across the world and the tools that existed 30 years ago, it's just been on the shelf. While money's been free, the tools have been on the shelf. They're starting to come off the shelf, and Japanese corporates are asking.
So you don't see yourself as a competition to banks? Because, I mean, they really want to attract their customers here in Japan, and they are very competitive. But that's not what you're trying to do.
No, definitely not. No, the way I always say it is, if you can get money from a bank, you should get money from a bank. If you can get money from the public markets, you should go get money from the public markets. But increasingly, that money is less flexible. There's a standard way, standard document, standard issue to access the public markets. And similarly with the banks, with capital charges going up across the globe in certain asset classes where regulators want banks to push that to the capital markets, who's going to provide that? So we have to step in to provide that. Now, the interesting thing is a lot of that stuff that the banks were doing, it's not going to a private credit fund. It's not going to an opportunistic credit fund. It's not like that can be lent at 12% rates of return. We're talking about money that needs rates of return of plus 200, plus 300. This is investment grade quality stuff. Top of the capital structure, secured, senior, very low losses, long-term track record. And that's where we step in to provide that the banks no longer want to do.
Because when I've heard you talk about the volatility in the markets in the sense that private credit, for example, you just want to mitigate the losses. So how are you really hedging when it comes to really trying to keep it safe for perhaps the more conservative-minded investors, especially here in this economy?
Well, this is a great question. So when we provided $11 billion of credit to Intel, and it's at high investment grade rated, is that private credit in your definition? Well, it's about this definition. Like the way that private credit was first defined was what banks pushed out of their system first, which was the risky stuff. It was lending to sponsors, lending to mid-sized companies. But you're lending 0 to 6 times EBITDA. You can pick your number. You expect a 4 or 5% loss rate or default rate, and then you pick your recovery number for a loss rate. When we talk about credit that is private, we're talking about investment grade. We're talking about senior, we're talking about secured, we're talking about capital at the top of the capital structure. And so the vast majority of what we do is that. You should expect very little losses. And in fact, when we go to clients, when we partner with clients on the capital side, we're buying this stuff right alongside them in our insurance company. And when you think about the mentality of when we buy this stuff, the mentality is when we buy an asset, it needs to satisfy an obligation that we promised for 10 years from now, 20 years from now. It's not about the fee income tomorrow. It's not about the carry that we can generate over the next 2-3 years. This is about making sure that we're in business 20 years from now to satisfy the obligation that we've made. And so our proposition to clients is we'll buy this right alongside you, because by and large our clients are making the same promise to their pensioners or their retirees.
Matthew, you know I'm going to ask you about Challenger, and I do wonder, does that go to fulfilling that obligation down the track, right? We saw the big wipeout in Challenger's stock price after Apollo reduced their equity stake earlier this month. Is this a sort of existential threat to that relationship that some fear, or is it simply that, you know, there are higher returning opportunities given that this is a very capital intensive and perhaps slow to, you know, return business here?
Well, look, the Australian market is a wonderful market for our business model, and, by the way, for Challenger's business model. It's been a market that has done a phenomenal job introducing a defined contribution pension system called the superannuation system, and has been a wonderful savings tool for most people who've been working. As Australians start to retire, guaranteed income is going to be required in many of the offerings that these superannuation funds are going to be offering their members. And so I think companies like Challenger, who are the #1 player of providing guaranteed income in the Australian market, will have a very unique opportunity. But for us, you know, our decision is a little bit more related to the opportunity we see globally, which is we have a once-in-a-generation opportunity to help facilitate the transition of capital being provided by the banks, capital being provided by the public equity markets, being pushed into the private markets. And that's already happening in the U.S. It's been happening for the last 15 years. It will continue to happen for the next several years. It's going to next come in a major way to Europe as well. You saw the Draghi report where he talked about the things that Europe needs to do. One of the major elements of his proposal was create a unified capital markets, push more lending into capital markets or private market players. To build that capability, which is a once-in-a-generation opportunity, requires capital. At the end of the day, if we can continue to originate excess return per unit of risk, we can offer our clients really good outcomes and products in guaranteed format or non-guaranteed format. And so that it was more a global macro decision about how we can take advantage of a really interesting generational shift.
Matthew, Mark, when he was in Australia early in February, talked about a ton of mandates from Aussie super funds, right? Can you give us an update on that? Is there still that continued engagement and interest?
Yes. Business continues to be very good in Australia. We have really good engagement on both the accumulation products as well as helping supers start to think through what products do they want to bring to their members in retirement.
Matt, and before we let you go, I know you've pulled out of the real estate equity business, but where do you see then the opportunities to, as you've put it before, filling in the gaps in Asia? And will that involve more staff? I know you've been recruiting a lot.
Yeah, no, we continue to hire, and we've got a really good team out in Asia. The major gaps that we find are high-grade. We call it high-grade alpha, but it's doing things like what we did with Intel, what we've done with Anheuser-Busch, what we've done with Air France, lending to investment-grade companies in a private format. We get a little bit of an uplift because it's private and it's structured, and these companies get much better accounting treatment and flexible capital to pursue some CapEx plan or pursue some project or some balance sheet objective that they have. That's a big opportunity. Asset-backed, through our acquisition of Atlas, which is the business we bought from Credit Suisse. We have a platform in Australia. That business is doing really well. There are many opportunities in Australia for that asset-backed platform, and then to expand that across Asia. The third is our hybrid business. You know, in Asia, if you're an entrepreneur, or even if you're a sponsor right now, where do you go for equity if you don't want to sell control? It's tough to access the public markets, especially if you are a mid-sized company.
And that's big for you in India.
It's big for us in India. It's big for us in Southeast Asia. It's going to be big for us, I think, in Japan. And so our hybrid business is also a very big business for us. Will be a growing business for us here in Asia.
Michelini, good to have you with us.
Thank you for having me finally.
Here in the Tokyo studio, head of Asia Pacific at Apollo, joining us in the Tokyo studio. We have more on the Asia trade. This is Bloomberg.
Well, as spot markets increasingly bet on a 25 basis point rate cut by the Fed next week, Bloomberg opinion columnist Shuli Ren says that among those looking forward to the central bank's easing will be billionaire landlords in Hong Kong. She's with us to explain why. So talk us through sort of how interest rates at the Fed, I mean, we understand the dollar peg, of course. How does that pass through to Hong Kong's property tycoons?
So about 60% of Hong Kong property companies' debt are floating rate. So federal rate cuts directly impact how much the landlords are paying for their interest. But that's the most direct interest rate effect. But more importantly, right now, Hong Kong's commercial real estate market completely does not make sense in that it has a very negative carry, in that the rental yield that a landlord can get is way less than the financing cost, which is packed to the U.S., right? So for Grade A offices in Hong Kong, the rental yield is only about 3.2%, but the borrowing cost for the best landlords is about 5%. So when landlords, when they try to refinance bank loans or for the more in-debt ones, the ones that need to dispose their assets to pretty up their balance sheets, they have to tell the new investors or the bankers whether the value, the property value that's being assessed makes sense. So when the borrowing cost comes down, they can at least somewhat make an investment case for Hong Kong's commercial real estate market.
There are concerns really globally when it comes to commercial real estate, right? Tell us a little bit more about the situation specific to Hong Kong, especially after the pandemic, especially after the pro-democracy protests.
Yeah, so globally, commercial real estate is not happening. And in Hong Kong, we see that the office vacancy is 15%, and in Central, it can be as much as 25%. But I think the dynamic is a little bit different because globally, we hear a lot about work from home. Office workers are just not coming to work anymore, right? But in Hong Kong, I mean, the apartments are very small. People are still, and the Asia culture is a little bit different. So people are still coming to work. But the problem is that, especially in the business districts, there are two big tenants. One is the government, and the other is the financial services industry. And unfortunately, financial companies, banks, asset management companies, they're laying off workers. They simply just do not need so much space. And in the past, Hong Kong real estate market, they were hoping that a lot of mainland asset managers can, open offices in Hong Kong because they want to, trade globally. But we all know what's happening with mainland China's financial services industry. Like recently, we have two big brokerages, Guotai Junan and Haitong. They're going through a merger. So the question is, do you still need two separate offices, or you can combine them and shrink them into one? And I mean, we've seen that with the Credit Suisse and UBS, right? And it's the same dynamic that's being played out.
Bloomberg opinion columnist Shuli Ren there. Now, China's slumping economy and cooling consumption put the spotlight on the international growth for domestic companies, including hot pot chain Haidilao. Yang Lijian, CEO of Super High International, which runs the chain's overseas business, spoke exclusively with Bloomberg on their global outlook.
Our expansion plan is to seek development along with stability. We have been present overseas for nearly 10 years. We now run around 120 Haidilao restaurants outside China. We think this is a good number, and we are at a good development stage in terms of our talent reservation and experimentation with markets. For example, our Southeast Asia markets are quite mature. Those in Malaysia, Singapore, and Vietnam, as well as in South Korea, Australia, and Canada. Table turnover rates are quite high in these countries. We will deploy money to expand stores in these mature markets first.
What about the markets that you're looking at, the new markets for potential expansion? Where are you looking?
For new markets like Europe, we will explore those as well. The Philippines is where we have looked this year, and it's been quite good. But we won't do much exploration in the near term. For the next 2 to 3 years, we will deeply cultivate the dozen countries where we already have a presence.
Talk us through what you saw in the first half revenue growth for Super High International, and where are some of the opportunities to continue building on that?
We feel very optimistic about our company's operation status in the first half of 2024. The financial results have met our expectations. The table turnover rate has reached the peak of the second half in 2023, which is 3.8 times per day. Revenue has grown some 14% year-on-year, and profit margin is also slightly higher from the same period last year. These 3 dimensions suggest our state of operation is quite healthy.
There was a loss for the first half. Do you see any opportunities to kind of constrain the costs for the business, rein that side of things in?
Our losses are not due to poor operation. We have to look at whether revenue and profit have grown. The losses came from 2 areas. One was exchange losses. The other part is that we listed on the Nasdaq this year, and there were some costs, like consultation fees, that were not categorized as an operating loss. We think these 2 losses are normal.
Can you share a bit more details about, how potentially the business is going to deal with competition?
Competition in the restaurant business is very fierce because the bar for entry is so low. Haidilao is my first job, and for the past 29 years, I have been treating every day as if on thin ice, always thinking about what better service, products, and environment I can provide for customers. Our strategy over the years is to focus on being number one, starting from one particular area, whether it's service or products. If we can't be the number one in a city, then we can become the number one on a street. Our ultimate goal is to be the top hot pot restaurant in a city. So we always focus on markets, customers, and our employees. Also, we learn from our peers, things they have done well, while continuing to innovate ourselves.
Super High International CEO Yang Lijian there, speaking exclusively with Bloomberg's A. Rohong. Take a look at what we're watching when it comes to FX, and of course that reversal of the yen trade, really just part of what is really sending Japanese equities to the outperformance status at this point in the trading session. We're seeing the topics at the best in almost just over a month, and the Nikkei 225 putting on more than 3% and halting that 7-day drop with that weakness in the yen that we're seeing at the moment. Dollar yen trading at that 142.86 level there. We're also watching dollar China as we expect to get the August activity data to show yet more losing of momentum when it comes to this softness in the economic recovery. The weakness in the dollar really is the biggest focus here as we continue to kind of see how that plays out. The steadying of the greenback as we had the CPI numbers really dampening those expectations of jumbo-sized Fed rate cuts. More ahead on the Asia trade. This is Bloomberg. take a look at how we're trading as we see a little bit upside when it comes to US futures. Of course, the S&P 500 had ended, well, now reversing those earlier gains, I should say. We did see S&P 500 in the previous cash session ending higher by 1.1%. The Nasdaq outperforming with a rally of over 2% there. We are seeing that uplift when it comes to broader Asian chip names that will continue as we get into the start of trading in Taiwan. TAIEX futures looking like we'll see that pop at the open, Shery.
And that push really when it comes to the tech sector being felt across the Nikkei, across the Kospi, you can see those gains. And Japanese stocks reversing 7 sessions of losses, while the Kospi is also gaining ground across the board, up 1.3%. Of course, we also had PPI numbers surprising to the downside in Japan. We'll be following the open in China. That's it from the Asia Trade. This is Bloomberg.